This is the most important financial season of your life. You've spent decades saving and investing for retirement, but the 5 years leading up to it will make or break your plan. This stretch is what we call the retirement optimization phase, and it's where good preparation turns into lifelong confidence, or small mistakes snowball into stress for many years to come. In today's video, we'll break down what to do in these 5 critical years before retirement, how to rebalance your risk, lock in reliable income sources, and model your withdrawal strategy so you know exactly how your savings will support your lifestyle. And before we dive into all that, my name's Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm where my team and I help clients nationwide make smart money decisions. Let's get started. The retirement optimization phase is roughly the 5 years before and the 5 years after you retire. In this 10-year window where market volatility, poor timing, and bad planning can have the biggest impact on your lifetime income. Why? Because this is when you're transitioned from accumulation to distribution. In other words, you're going from building your wealth to living off of it. Every decision now about investments, taxes, Social Security, and income will echo on for decades. In this phase, your focus shifts from how much can I earn to how do I protect what I've built and make it last for the rest of my life. The first priority here in this phase is to rebalance your portfolio. After years of market growth, many investors enter their 60s with portfolios that are too heavily weighted in stocks. That can be dangerous. A major market drop right before retirement or during the early years of retirement can take you years to recover from. And if you're starting to take withdrawals during that downturn, your portfolio might never bounce back. This is called sequence of returns risk. When the timing of bad market years early in retirement magnifies losses because you're withdrawing money at the same time your investments are down. And to avoid this, here's what you're going to want to do. Shift gradually from growth to stability. You don't need to abandon stocks entirely, but consider rebalancing the 60 or 70% in stocks and the rest in bonds, depending on your risk tolerance and income needs. You also want to think about adding short-term reserves where you're keeping 2 to 3 years of expenses in cash or short-term bonds, so you're not forced to sell investments during a market downturn. And finally, review your diversification. Make sure your equity allocation isn't concentrated in one sector like tech or U.S. large cap stocks, which is what we're seeing right now, and that your bond holdings have reasonable duration in today's rate environment. This isn't about timing the market, it's about controlling risk when it matters most. But with all that said, a lot of it depends on how well you've saved. For those of you who have saved just enough for retirement and will live comfortably, what we just went over is a great strategy. But for those of you who saved well more than what you're going to need, you can afford to be a bit more aggressive. These assets will likely pass on to children or charity or some other loved ones when you're gone, so you can afford to invest the funds for a lifespan that will outlive yours. But on the flip side, if you go through this exercise and you're finding you're not going to have enough money for retirement, now it's time to make decisions. Do you work another 6 or 7 years as opposed to 5? Maybe pick up part-time work somewhere once you are retired? Or find ways to cut down on the budget. Paying off debt while still working is a great idea to help your transition to become more smooth if you find you have a shortfall. The big takeaway when rebalancing is forecasting out what you think you will need and moving on to the next step, which is your withdrawal strategy. Once your investments are balanced, the next step is knowing how you'll turn them into income. A great portfolio means absolutely nothing if you don't have a clear withdrawal strategy. Here's how to model it. Estimate your annual expenses first. This includes housing, healthcare, insurance, or other essentials, and discretionary items such as travel, hobbies, and gifts. You want to identify the guaranteed income streams you have coming in, so add up things like Social Security, pensions, and any annuity income that you have, and then calculate the gap. Whatever expenses aren't covered by guaranteed income will come from your savings and investments. Now you can start designing your withdrawal strategy. First, you want to utilize a bucket approach and divide your portfolio into short-term, which is cash or short-term bond reserves, medium-term, which are intermediate bonds and dividend stocks, and long-term growth, which is for growth assets such as your tech or small cap funds or emerging markets. Then you're going to want to withdraw from your safer assets first when markets are down to protect your equities, and then you're going to replenish that short-term bucket when markets recover. This creates a self-adjusting system that helps your money last through both good and bad markets. Other clients like looking at it from a lens that all spending is necessary. So they'll add in vacations, hobby, and other discretionary expenses on top of their everyday items and say, this is what I want to spend on a monthly or annual basis. And they're going to come up with that total spending number. And we back into that total spend number and see if their assets will cover it. And again, we're counting for Social Security, pensions, and annuities first. If they don't have enough, they have a decision to make. Either work longer, spend less, or find ways to generate more income from their investments without creating too much more risk. And to piggyback more onto withdrawal strategy, this is where you need to start thinking about taxes. You want to have a concrete plan as to the order in which you will withdraw your funds based on account type. I often find the most successful retirees don't just think about how and where to invest their money, but how they're going to take it out as well. Having a tax-efficient withdrawal plan is often just as good, if not better, than earning an extra % or 2 on your investments. And the best part is you don't even have to take on more risk to get that extra return. We're going to cover this a little bit later on in the video, but this is where you want to start to begin thinking about taxes in your retirement picture. Retirement income isn't just about investments. It's about guaranteed paychecks you can rely on regardless of market performance. Here's how you want to strengthen your base. First, start with your Social Security. Don't rush to claim it if you don't have to. Waiting from age 67 to 70 increases your base by about 24%. If you're the higher earner couple, delaying can also secure a larger survivor benefit for your spouse. Use the years before you retire to run the math on your claiming options and coordinate it with your withdrawal strategy. Sometimes it makes sense to use savings early so you can delay Social Security and lock in a higher lifetime income. In other scenarios, it makes sense to take it earlier. You want to model it for your own specific situation. Next is you want to look at other guaranteed income sources such as pensions and annuities. So compare your lump sum value of your pension to the monthly payout options. For those without pensions, consider using a portion of your savings to purchase an income annuity that guarantees a lifetime payout if you want a more solidified income plan. The goal isn't to put everything into annuities. In fact, I would argue this should be a last case resort for most people, but it's to create a baseline of reliable income that covers your essential expenses no matter what happens. Sometimes the higher guaranteed payout and peace of mind is worth the higher fees. If it means sleeping better at night, annuities can certainly provide you a more concrete income plan. Finally, you might want to reconsider part-time income. If you plan to work part-time or consult in early retirement, factor that into your income model. Even modest income can dramatically reduce the amount you need to withdraw from your portfolio, buying time for your investments to grow. But also be aware you want to factor that into your income picture and account for that when paying your taxes at the end of the year. Now we're going to talk about taxes. The 5 years before and the 5 years after retirement are your last best window for tax optimization. Here's what you want to focus on. First and foremost, Roth conversions. If your income is lower than it will be once Social Security and required minimum distributions kick in, start converting pre-tax assets to Roth. This shrinks future taxable income and gives you tax-free withdrawals later on, giving you more flexibility. Second is you want to utilize capital gains planning. You can use the 0% long-term capital gains bracket, which is about $97,000 of taxable income for couples and about $47,000 for single filers, to harvest your gains strategically. Third, consider charitable giving strategies. Consider donor advised funds or qualified charitable distributions if you're over 70 and a half to shrink your taxable income. And then you want to finally think about your withdrawal sequencing strategically. Plan which accounts you'll pull from first. A mix of taxable, tax-deferred, and Roth gives you flexibility to manage brackets each year without pushing you into higher income tax brackets. Think of this as building your tax diversification before you retire, so future withdrawals don't push you into higher tax brackets unnecessarily. The fifth step is to review your healthcare and insurance coverages, and healthcare is one of the biggest wildcards in retirement, so start preparing for it early. If you're retiring before the age of 65, you'll need bridge coverage until Medicare kicks in. Explore COBRA or Affordable Care Act options or part-time work with benefits. Once you're eligible for Medicare, plan how parts A, B, and D fit your needs, and whether you want a Medigap or Advantage plan. And finally, don't overlook your long-term care plan. The average cost of private nursing home exceeds $120,000 per year. Consider a hybrid life insurance policy with long-term care riders or a dedicated long-term care policy to help pay for this need, especially if most of your money is tied up in traditional funds. The tax burden of a long-term care event can be massive. The average long-term care event is about 3 years, and after taxes are accounted for from taxable accounts, that can wipe away almost $500,000 of wealth in the average scenario. This is the perfect time to make these decisions while you're healthy and insurable, so that way your cost of insurance is low so you get the most bang for your buck. Before we move on to step 6, I wanted to take time to thank you all for watching our videos. It's been amazing to see our growth of the channel over the past 12 months since we started, and we're excited to keep growing this thing through 2026. If you're still here, please show this video a like and subscribe to the channel. Your support means a ton to me and the team here at NAV Wealth, and we look forward to continue helping you on your retirement journey. Let's jump back into the video. Step 6 now is paying down high interest rate debt. Entering retirement debt-free can reduce your income needs and lower your stress later on. Now, that doesn't mean rushing to pay off a low-rate mortgage, especially if you're under 4%, but you should eliminate all high interest rate debt. things like credit cards, personal loans, or car payments before you retire. If you plan to downsize your home or relocate, start exploring these options now. Selling while you're still working gives you flexibility and reduces financial pressure later on. It also can decrease your living expenses now while you're working, and it's dependent on when you bought your current home and what that mortgage rate is. If moving now saves you a few hundred or even $1,000 a month, that is money that you can now allocate towards paying off other high interest rate debt or enhance your savings in your taxable brokerage account to give you more flexibility later on. Now, before you officially retire, your next step is to take this plan for a test spit. Spend 6 to 12 months living on your projected retirement budget. Track expenses and see how it feels. Do you have enough for travel, entertainment, and unexpected costs? Are you withdrawing more than you planned? You want to use this time to fine-tune your plan so you can adjust your discretionary spending, and this is when most clients actually find that they can spend more than they thought when they were originally building out their plan. You can revisit your investment allocation if withdrawals do feel tight, and you can test different Social Security start dates and withdrawal sequences using a planner or financial modeling software to help you decide when to take Social Security. The stress rehearsal helps you uncover gaps in your plan before they actually become problems, because you can always fill those gaps with the income you're making at your job. The optimization phase isn't just about money, it's about control. Make sure your estate plan matches your retirement reality. So before retirement, make sure you review and update your will, power of attorney, and healthcare proxies. Confirm beneficiaries on IRAs, 401ks, life insurance, and annuity policies. And consider setting up a trust if you want to simplify estate settlement to protect your heirs. These documents ensure your assets transfer smoothly and your healthcare wishes are honored if something unexpected were to happen. Furthermore, this could be your biggest tax savings. Married couples will have a lifetime exemption of $30 million moving into 2026. If you are projecting to be over that limit, you will face tax rates as high as 40% on the amount over the difference over the amount. A prudent gifting strategy and proper trust setup can reduce their burden and keep more money in the family after you're gone. So that way they get to keep more of what you work so hard for. Moving on to step 9 now is you want to build a cash reserve for your transition. The first year of retirement often has unpredictable expenses, home projects, travel, healthcare adjustments, things like that. Build a dedicated cash buffer of 12 to 24 months of living expenses before you retire. This cushion will help you to avoid drawing from investments during a market downturn, pay large one-time expenses without derailing your plan, and transition psychologically from a paycheck to a portfolio withdrawal with confidence. Think of this as your runway, the space that lets your plan lift off smoothly and ensure your confidence moving forward into the later years of retirement. Finally, the hardest part of the retirement optimization phase isn't financial, it's mental. For decades, you've been focused on saving, investing, and watching your balance grow. In retirement, that goal flips. Your success now depends on sustainably spending what you've built. The mindset shift can be tough, especially for disciplined savers. The key is structure, knowing where each dollar comes from, what your safe withdrawal rate is, and how to adapt when markets change. A strong plan gives you permission to enjoy what you've worked for without fear or guilt of running out of money. The 5 years before and after retirement, or your retirement optimization phase, are the most important financial window of your life. This is when you secure your income, reduce your risks, and lay the foundation for decades of financial freedom. To recap this checklist, first you want to rebalance your investment risk, model your withdrawal strategy, then lock in your income sources like Social Security and pensions, followed by optimizing your taxes through conversions and sequencing of withdrawals. You want to make sure you review healthcare and long-term care coverage. You want to eliminate high interest rate debt before you get into retirement, and make sure you take everything for a little bit of a test drive so that way you know if your retirement budget is feasible. After that, you're going to update your estate beneficiary documents in case anything should happen to you. Building your transition cash reserve is the 9th step. And then finally, once you're in retirement, shift your mindset from saving to spending with purpose. If you want help designing your retirement optimization phase roadmap, one that balances income, taxes, and lifestyle, that's exactly what my team does here at NavWealth Partners. We'll help you make this transition with clarity and confidence. Just schedule via the link in the description below. As always, thank you so much for watching, and make smart money decisions.